Good afternoon. You're watching us here on Halftime Report. I'm Manglam Malu. With me, as always, Ekta Batra as well as Sonia Shenoy. It's a good-looking screen this afternoon. In fact, the good part is that dips are being bought into. We opened well. Thereafter, there was a bit of a slip from the top, and that has been bought into. Now we're making our way back again above, 17,500 mark, just around that for the frontline index, and giving it company are a lot of these good stocks. We have a rally that we've seen from Tata Motors, which has moved to the high point of trade. L&T, a heavyweight on the index. ITC is doing well, and as is Reliance. So we do have a bunch of stocks which are doing well. 3 stocks in the green, 1 in the red.
Oh, absolutely. And it's looking really good, even if you're a technical expert, right? The market is now above the 20, 50, 100 and 200-day moving average. I think the last level on the upside to conquer was the 50-day moving average of 17,490, and we have managed to do that. So the bulls have sort of tightened their grip on the market. Even FI selling has reduced quite a bit in the last few days. So I guess it's all guns blazing, perhaps an early Diwali.
Yes, absolutely, Sonia, Manglam. And what really stands out is the kind of gains that we're seeing within the banks and the financials. I know it's only 2 days of trade, but on a week-to-date basis, just look at the way State Bank of India has moved. It's already gained around 6% and even something like an ICICI Bank, which is up around 3% on a week-to-date basis at current reckoning. So we don't know how the trajectory would go. And remember that these banks are still to report their numbers. IndusInd Bank also up around 3% So there's definitely a lot of strength which is coming into the financials. You can see that in the Bank Nifty, which is up close to around 400 points at this point in time as well. But let's kickstart the show with our special segment, Insight Edge. Manglam is focusing on VMart today. It's been an interesting acquisition that they made, LimeRoad. And Manglam, personal experience is that the ads keep popping up on my phone. So what is the background? What does this mean for VMart?
The ads keep popping up because, a lot of people who buy products on LimeRoad, you might not be their target customer because nearly 70% of their sales come in from products which are less than average sales price of 499 rupees. But having said all of that...
You can get a lot in under 500 rupees.
Yeah, you can, but
you can.
we're
all bargain hunters, by the way.
We're all bargain hunters, and most of their customers are in the UP. So, that is, geographically, perhaps, we're not the right target customers as well. But, be that as it may, they've bought LimeRoad, fashion and lifestyle pure play online commerce company, for a total investment of around 67 crores, which includes about 30 plus crores in cash, and the rest are the liabilities that they are assuming. Earlier, VMart had originally, envisioned to invest 100 crores on e-commerce over the next 3 years. So this is, a way to go ahead and make that faster, and also at the same time at a similar cost itself, if you take note of the time value of money, etc. Over and above the 67 crores, over the next 3 years, they will also invest around 60 to 70 crores to increase their online sales as a proportion of their overall sales, which are sub about 10% of their overall sales. This is likely to grow to over 20% in the next 24 to 36 months. Now, where are the synergies? One, LimeRoad has a strong customer base in UP, and VMart has their highest number of stores in UP itself. 70% of LimeRoad's customers and 65% of VMart's customers are from non-metro and tier 1 cities itself. 30% of SKUs or products sold on LimeRoad have average sales price of sub 499, and VMart has 56% of its sales coming in from sub 499 as a price point. So there are overlaps in that, and VMart can actually benefit from that. Not just that, LimeRoad's contribution margins 32%, VMart's gross margins around 34%. So those are the overlaps which VMart can benefit from. The only problem is that LimeRoad's revenues over the last few years have been declining. Pre-pandemic, it was over 500, 600 odd crores, and then FY20 it was 180 crores, and now it's just around 69 odd crores. However, the management of VMart joined us here on CNBC-TV18, and this is where the insight came from. They said that, the capabilities that they have, they can actually scale this up to 5 times from what it currently does. Currently, it does about 10 crore rupees per month in terms of sales. In the next 12 months, they can actually scale it to 50 crore per month. So that would enable the company to do about 600 crore in terms of revenues. While they're making an EBITDA loss, they will actually turn positive in the next 2 years as well. So that is something perhaps that the street likes, the overlaps that there are, and the road to getting more revenue coming in at a slightly profitable level in their overall sales mix. So that's where the insight came from.
Okay, and in fact, we had a chance to speak to the management as well. Earlier today, they told us about, the fact that they also don't want to make any more. They want to go through the organic route. They're not looking at too many inorganic moves at the moment. And in fact, let's hear it out from Lalit Agarwal himself, the founder and MD of VMart Retail. Remember, LimeRoad is still loss-making. So they spoke about that as well, how they plan to turn it around. Listen in.
This is definitely a very good acquisition that we have had, and this is a great team. LimeRoad, which was run by Suchi, so she's the founder, Suchi Mukherjee. Slowly and gradually, this millennial crowd is definitely going to acquire more and more digitalization, and that's where we are getting prepared for, and that is why we took up this opportunity. And this is a great team which has a great technology, and we could really build onto that. But yeah, as far as revenue is concerned, they had a very good peak pre-COVID, and post-COVID, they have gone a little bit down, and they have suffered. But as of now, it has a 10 crore plus run rate per month. But yeah, I think we will definitely scale it up immediately within the next 12 months to the pre-COVID levels. There is a loss which is small right now, but I think we could, with the expertise at VMart, the product expertise at VMart, the qualities that we can offer, and the kind of deliveries that we could offer from our stores, which are 410 doors as of now, where the customer delivery could be much cheaper and much faster. That's the opportunity that we'll try to use and make this system efficient. And that's the real omni piece which will come in and could become efficient and profitable in the next 2 years.
Okay, so that's the management of VMart. The stock is up around 2%, bullish on that particular acquisition. But let's move on then. Adani Transmission is in focus after a strong operational update for the second quarter. Vivek is standing by with all of the details on this story. Vivek.
Well, that's right. So Adani Transmission posted a very encouraging set of operational updates as far as Q2 was concerned. So now the company that's present both in the transmission as well as the distribution segment actually gave a separate update for both of these segments. So the transmission business has actually done quite well. The company actually managed to operate the transmission lines upwards of almost 99.76%, which is again very operationally strong. But when it comes to the distribution segment, the management has actually increased the utility as far as the distribution space was concerned by almost 13% on a year-on-year basis. Other than that, the management has also managed to go ahead and narrow the distribution losses, and this time around in Q2, the distribution losses stand just at around 6% versus 7.64% last year around. So on the back of these operational updates, you're actually seeing the stock doing quite well in the session today.
All right, thanks a lot for that, Vivek. That's Adani Transmission up 3.5% right now, and volumes picking up as well. But don't lose sight of what's happening in the market. It's still standing tall. 17,500 is where the Nifty is currently. The Bank Nifty is the one that's really supporting the market this afternoon. And across the board, I mean, Adani Ports is your biggest gainer right now, but then you have SBI, ITC, Bharti Airtel that are big movers. So back at the high point for the market. But a number of pharma stocks are also in focus today. Ekta, what are you looking at?
Well, yes, a lot of the pharma as well as the healthcare stocks. I'll start with Aster DM, that particular hospital company is in focus because they've entered into a joint venture which will be to enter into Saudi Arabia to establish their pharmacy segment. So the joint venture will be establishing, managing and operating pharmacy chains across Saudi Arabia. The company will market and commercialize pharma products under the Aster Pharmacy brand. The company aims to set up and operate around 250 plus stores over the next 5 odd years. And phase 2, interestingly, will be to set up pharma manufacturing within the kingdom as well. They already have a hospital which started in Riyadh in 2016. So it is an expansion within this entire geography. RPG Life is reacting to its numbers, revenue up 20%, margin stable at 22%, profit at close to 20 odd crores on a year-on-year basis. It compares to 15.75 crores. Q on Q as well, revenue up 5% and the profit too has improved on a sequential basis. Gland Pharma is the other one that I'm tracking today because Morgan Stanley has initiated on Gland with an overweight stance and a target price of 2748. They say that Gland's entrenched presence is in a difficult injectable category, and they have a capital efficient business model. They forecast around 22% EPS CAGR for FY23 to FY24. So they are definitely bullish on Gland Pharma. And the last one that I'm tracking is Alembic because the US FDA has inspected the company's oncology injectable formulation facility and they've issued 4 observations to that particular facility. The company says procedural observations, no data integrity, and they are addressable. So let's see what it eventually throws up. But nonetheless, the stock is down around 1% at this point.
All right, Ekta, thanks a lot for that. Take a short break on that note. In fact, as we do that, also as investors, there's some great news for you. You can now track the US markets real time on moneycontrol.com. Log on to their website or even the app. Stay informed about all matters that matter in the global markets. Welcome back. You're watching us here on Halftime Report. Let's get you a quick handle on what's taking place in the F&O space before we go across to Sachidanand Uttekar. The Nifty high today was 17,528. We're off those highs mildly, and we're around that 50-day moving average. So that's telling you that maybe initial resistance to actually cross over that mark with a big bang is something that the street is looking at. Why is that? Because from yesterday's low, we've already rallied about 400 points. Yesterday's low was close around that 17,100 mark. So could there be a bit of a pause and thereafter there would be a rally, or buying the dips would be an interesting strategy? And in that, data suggests that over the last few trading sessions, the base of the Nifty has actually increased from 16,950, 16,660, where the Nifty made a low between October 11 to 13. Over the last couple of trading sessions, the base has increased to 17,100 to 17,170. So those levels, if the market moves towards that, those dips could be bought, or you could see buying in those levels. As far as the calls are concerned, massive short covering seen in 17,200 as well as 17,300 calls. At the same time, the 17,500 call has been seeing some bit of writing. We're also seeing writing at the 17,400 put and the 17,500 put. Let's see where the market goes from here. If we sustain above 17,500 for a long time, there could be these call writers who would cover their positions, and all eyes will then be on September 23rd high of 17,642. Why is September 23rd high important? Because it was from these levels where the market started declining to levels sub 17,000 as well. So those are a couple of factors I thought, which are interesting right now. The other part is that this month, the Nifty is up 2.5%. The mid-cap index is absolutely flat. So were the markets to recover and see further short covering, I would perhaps look at mid-caps to outperform or catch up with the underperformance.
Okay, so you're watching that September 23rd high of 17,640. That's perhaps the next level on the upside. Sachidanand Uttekar joins in. He tracks the markets at Trade Bulls. Sachidanand, good afternoon. So this market has managed to conquer the 20, 50, 100 and 200 DMA for now. Tell us, is the going good for the bulls, and would you take a fresh position, a fresh long position now?
Good afternoon, Sonia. Certainly, yes. In fact, Mangalam was just mentioning the data points of 23rd September. If you look at all these, data points, one data point that I would like to add is the Nifty RSI, which has moved to 50 mark, and it is trending above the same. Now, this was seen, just before 23rd of September, when Nifty was comfortably trending in a higher top, higher bottom sequence, and the RSI was placed above 50 marks. So 23rd September, that was the first time when we saw that knee-jerk reaction, and Nifty corrected substantially towards 17,000. So right now, I think the base is getting elevated. The 17,300 gap up that we have seen, I think that particular level could act as a fresh base going forward, and that's why we believe that Nifty could scale further towards 17,630 eventually. So buying declines is healthy. The stop loss should be placed at 17,430 when it comes to Nifty spot levels. On an immediate basis, we are expecting this particular move to trend towards 17,580, and eventually the pattern target of 17,630 could be achieved in a day or so. When it comes to Bank Nifty, clearly the outperformance is because of the PSU banks, and I think now again the private banks may start contributing towards this particular strength. So even when we look at Bank Nifty data, we don't see it falling below that 40,000 mark from here on. The stop losses should be placed somewhere close to 40,130 when it comes to trading. We are expecting a quick swing towards 40,700 when it comes to Bank Nifty. So I think net both the indices are looking bright. If we see a consolidation or a corrective, I think that will be a healthy opportunity to build some fresh long positions.
Okay. I was just glancing through the list of 52-week highs today, and within the financial space, you have IDFC First Bank, Indian Bank, City Union Bank, Federal Bank. So there's a lot of traction which is taking place in the broader market banking stocks. Anything that you're specifically looking at, targeting, recommending technically?
Good afternoon, Ekta. Ekta, clearly the structure of City Union Bank was very good. In fact, for the last 2 or 3 weeks, we have been recommending longs in this particular space. And when we look at the entire structure, if you look at the weekly charts, there's a clear-cut bullish flag formation which has got activated above 185. The pattern target of this particular structure is almost around 220, so it's a long-term pattern target that we are looking at. But on an immediate basis, we do see it swinging towards 200, 205 on an immediate basis in a month or so. So I think this particular structure has evolved really well. SBI is again, contributing well. So right now we have already participated on the PSU side. I think again we may see one more round from the private sector private sector banks that would contribute for this next leg towards 40,700 for Bank Nifty.
Okay, by the way, talking about big movers, Newgen Software's numbers are looking pretty good. On a sequential basis, it's over a 20% rise in the top line. EBITDA has almost doubled and the stock is surging away, 6% higher now on Newgen Software. And the other stock is Data Patterns in the broader markets, a fresh high on that one. These defense electronic companies have done exceptionally well, and Data Patterns has had a smooth run. In fact, in the quarter gone by, its revenues almost doubled. So even the fundamentals looking good. It's an 80% rally in this stock this year. But thanks a lot, Sachidanand, for joining in. Let's slip into a short break. On the other side, we'll connect with Prashant Mehra of
Welcome back. You're on the Deal Tracker segment. And remember, for the second quarter of this financial year, the deal flow has substantially slowed down across the board, whether it's M&A activity or private equity investments, and even the startup space raising funds or doing any transactions. Let's take it straight across to Prashant Mehra, the partner at Grant Thornton Bharat, joining us with the authored report findings for the quarter gone by and also the perspective on the deal street. Prashant, always a pleasure speaking to you and welcoming you to CNBC TV18. My first question, what are the primary reasons for the slowdown that we are seeing on the deal street?
Good afternoon, Nishant. Thank you for having me. Yes, you're right. I think if we look at on a month versus last year, deal flow has slowed down, both from a volume perspective as well as from a value perspective. But if you look at the 9-month data, there has been still a surge of about 50% plus in terms of volumes and about 20% in terms of values as well. I think the reason that is slowed down is anybody's guess. There is a global recession that is looming. While India's macroeconomic factors still seem to be strong, but lending rates are going up, there is a threat on what the future will be, which is why people are conserving cash and not spending it on acquisitions, mostly targeting organic growth and not inorganic growth. But I think that is a flavor for the next few months. The first quarter of the next calendar year is something that we should see deal activity come back. In fact, even towards the end of the year, in November, December, when balance sheets close globally, we should see deal activity happening as it happens every year. So but I think what's interesting to see in the trend is the fact that there are new sectors which are emerging as far as transactions are concerned. We've had some large transactions on the transport side, which is to do with infrastructure. But I think the overall theme still seems to be technology, directly or indirectly, whether it's retail tech, ed tech, or fintech. So wait and watch, but yes, we need to see what happens.
So while macro concerns are really impacting the overall deal flow, and you said cash is king right now, that's one of the important factors, but market volatility, and I'll call it volatility because we've seen also fair bit of, gains also like a day like today. Right. So what are the factors really impacting the valuations, and is volatility really holding back conversion of deals right now?
I think a bit of both. Volatility, yes. Volatility really defines the lack of confidence as far as the sentiment is concerned. And otherwise, people are conserving cash because if they believe that cash needs to be put into organic growth rather than inorganic growth, because any inorganic growth comes with its own challenges, mainly integration and return on investment. So it's cash is king as well as the global sentiment are both impacting deal activity, which is not unlikely at all. It's always been there. But I think that the Indian markets responding well, like the day today, will probably ultimately lead to a positive sentiment in the next quarter.
Right. So, Prashant, the two important deals which actually ramped up the amount, the deal sizes and the value for the quarter gone by have both been actually spillovers. They have been pending for a very long time. Yes Bank investment as well as SR and ArcelorMittal deal, which has been going on for last 4 years. So, are you seeing now spillover deals converting, or is there a wait and watch on that? And how is this particular quarter really panning out? We are already a few days into the quarter.
Nisha, you're right. I think any new activity will perhaps not be initiated, but anything that has been lingering on for some time will hopefully see a closure in the next few months. Global balance sheets close in December, as I mentioned, and it's always the case that October, November, December, particularly November and December, we see a lot of deals closing that have been on the back burner for quite some time, and I think that will happen. This year will not be different from any other year.
Right, IPO activity that has substantially slowed down as well. Any time you do see that equity window again opening, and separately for startups, is it going to open at all in the near future?
I think, yes, it will open. We need to tide over the volatility which is there in the market. I can tell you that, being part of an accounting firm, there is a lot of IPO preparedness that is still happening. When these IPOs will happen is something that will evolve in the next few months. But yes, preparedness is happening. I think the moment the volatility, at least this huge amount of volatility goes out in the market, we will see DRHPs being rolled out and IPOs happening between January to March next year.
All right, January to March, that's the hope at the moment. But also, Prashant, the inflation as well as the interest rate impact has to show up, and also how the Ukraine crisis also develops, and therefore the impact on Europe. But I wanted to understand specifically on the fundraising aspect of the startup space. There are several stages to startups. Is it very low ticket size and very cherry picking that the investors are really looking at? How is the scenario right now, and how gloomy is the picture for the startup industry going forward?
I'm not too sure if, the value of the investment is a criteria for private equities. I think the startup space has evolved over time. Anything which has strong fundamentals, anything which is not just about a revenue model, but is also about a business model. So there is eye on gross margin or being cash positive is something that the private equities will not hesitate to put their dollars behind, irrespective of the value.
All right, so some of the pending deals closure before the year ends, calendar year ends, and January to March is when we are expecting deal flow to pick up a little bit. At the moment, a little bit of standstill, wait and watch as volatility persists, and some of the macro events really impact the deal flow, and cash is king. That's the real summation of the takeaways from Prashant. Thanks so much for joining us. With that, it's a wrap on Deal Tracker. Get back on the same show right after this very short break. Lots of news and updates on the other side. Stay tuned.
Welcome back. Well, steady for the markets. The Nifty is up over 160 odd points at this point in time. We do have PSP projects. Net profit is down around 41% on a year-on-year basis. So it's coming at around 21.5 odd crores. There's a decline in the revenue as well. So that's down around 8 odd percent to 360 versus 390 crores year-on-year. Stock is reacting to it. It's been an all-round miss. Top-down miss, you'd have to say, for PSP. EBITDA is down around 28 odd percent. It's coming close to around 40 odd crores. So let's see. Margins have also contracted around 300 basis points. So that's on PSP. The stock is at the low point of the day, reacting to what is a dismal set of numbers. But L&T Tech will be reporting its Q2 numbers today as well. Rima is here with us to tell us what we can expect. Rima.
Thanks so much for that. These numbers are going to be closely watched because it's clear Tata Elxsi had disappointed the street on both revenues and margins, and we saw a slowing of growth from Tata Elxsi. So in that context, L&T Technology, another ER&D player, numbers will be watched. In terms of expectation, the CNBC-TV18 poll stands at a 2.9% dollar revenue growth quarter on quarter. Constant currency revenue growth should be 4.5%. So growth should be solid this quarter, aided by the ramp up of deals won in the prior quarters. Margins are likely to decline sequentially because of the wage hike, which is effective 1st of July. And that's the reason why the profit will be seen absolutely flat. Now, the key for L&T Tech will be its FY23 guidance. Now, unlike, say, an Infosys or an HCL Tech, which guides in constant currency terms, which means it's unaffected by the fluctuations seen in the currency, L&T Tech guides in US dollars, which means that when the euro as well as the pound appreciates against the USD revenues get negatively impacted, which could put downward pressure on their FY23 revenue guidance, which currently stands at 13.5 to 15.5%. CLSA believes that the company could lower their guidance on account of these cross-currency headwinds by 50 basis points. Kotak says they'll retain it, but their actual performance will be closer to the lower end. Also, watch whether the company holds on to its margin guidance, which currently stands at 18%. Growth is expected to moderate in areas like high-tech, telecom, medical devices. Typically, ER&D players get impacted when the going gets tough, and some of these discretionary spending gets cut in tough times. Back to you.
Okay, thanks a lot for that. Well, that's on L&T Tech, but in our special segment, Quarter Se Quarter Tak, Mangalam is focusing on the FMCG sector. Mangalam, what is it that we can expect this quarter around?
Big FMCG numbers this week. We have HUL, Asian Paints, ITC, Nestle, as well as Tata Consumer, all of them reporting numbers over the next few days itself. But, for the second quarter, it's an insipid quarter that the street is working with for FMCG companies. Why is that? Because of the twin problems. One, weak demand conditions, and secondly, all the companies are sitting on high-cost inventory. So those are a bunch of things that everyone's working with. And in terms of the management commentary that we've got through the quarter as well, weakness in entry-level products is something that the street has to navigate through. And, at the same time, while everyone is looking at this quarter as a bridge quarter between the first quarter of this year and the second half of this year, the second half is important because that is where you're expecting demand as well as margin recovery. So to that extent, this quarter may not be as important from a long-term investor standpoint. But despite that, we have some interesting trends playing out. Titan, for instance, announced an 18% jewelry growth on a high base. So that's telling you that the premium end is doing extremely well, whereas the staples where there is a problem. GCPL, mid-single-digit sales growth with mid-teen decline in EBITDA. You had the same problem with Marico as well. Consolidated revenue growing in just low single digits with no change in the EBITDA. And Dabur as well is showing mid-single-digit sort of growth with a decline of 150 to 200 basis points on the EBITDA. And this distinction is clear in regards with volume expansion, growth expectation as well. For HUL and Britannia, the volumes are expected to grow mid-single digits, slightly below that as well, between 3 to 5, 4 to 5 odd %. Whereas for bigger players, discretionary consumption, Asian Paints is expected a 14 to 16% sort of growth coming in on their business, and ITC cigarette volumes likely to grow by around 14 to 15 odd %. And it is this expectation in the second half which is baked into the price as well, because all these stocks are just around 5 to 6% away from their 52-week high. The FMCG sector has been an outperformer over the last 12 months. It's just Tata Consumer and Asian Paints which have been about 10% away from their 52-week high. Valuations for FMCG stocks have never been cheap, and we continue to see them at elevated levels for most of the stocks, between 37 to 61 times for Nestle. ITC has always had valuation support, currently trading at 21 times, despite the kind of rally that we've seen on the stock.
Okay, all right, Mangalam, thanks very much for that. That's on the entire traditional FMCG space. Just want to point out Nykaa, because Mangalam did mention that there are a lot of these stocks at 52-week highs or close to that, but Nykaa is sitting at the lowest level that it has seen in the past 52 weeks. So it's at a 52-week low. To put it into perspective, its listing price was around 2,000 odd rupees, and it's been a downward journey really from that level for Nykaa. Even its 52-week high, for example, was around 2,500 rupees plus. So since then, it's quite a journey on the downside. But we need to take a short break. On the other side, Manisha Gupta joins us.
Welcome back. Joining us on the show now is Kunal Shah, Head of Commodities and Currencies at Nirmal Bang. Kunal, hi, good to have you. The focus clearly is on the energy space, because we've seen some profit-taking continue for crude oil prices, but the larger declines clearly in space for the natural gas, where we've seen 7 to 10% of a cut come in for global natural gas prices, depending on what exchange you're looking at. Natural gas first, and what's your sense on this one?
I think natural gas prices in US are going to remain under pressure. One of the reasons is if you look at what is happening on the production front in US, the production is moving up quite sharply. So the shale oil and shale gas production in next quarter also is going to move up significantly. Earlier, the exports were not taking place. Right now, even the exports are taking place at rampant pace, but the weather is not supporting. So before the winter starts, we are going to see some more pressure building in natural gas, and natural gas prices in US. I'm talking about the US gas, not the European gas, is likely to go down by another 5 to 8% in next 1 month. So not expecting any major upside in near term.
You know, Kunal, the concern, while of course have been ahead of the winter season, and we do understand whether you're looking at Europe or UK for that matter, the stocking that they've done for natural gas has been quite on the stronger side, 90 to 100% in case of UK as well. During the winters, do you think it's a great idea to short, even when you're looking at Europe, the prices are down by 60%, the US gas prices are down by 28% as well from its highs in this year. Are we done this correction? Are we done this correction after 5 to 8%, as you said?
It all depends how the entire winter season plays out. So, for example, let us say the winter is going to be more harsh than what it is expected to be. Then you are going to see a sudden surge in the gas demand, and you may find that the supplies are not enough. So, it's a pure weather play from now onwards. Apart from that, the geopolitical situation continues to remain grim, and we don't know what is going to happen going forward. Right now, there are no indication that there is going to be any truce or there's going to be any peace talks to be held between US and Ukraine, or Russia and Ukraine, or US is going to be involved in it. So I would not give a call like aggressive go short on gas. I don't think so. The fundamentals are still bullish. We don't know. We are in an uncharted territory when it comes to this war between Ukraine and Russia, and we don't know what is going to happen next. Whether it is going to be converted into a full-fledged geopolitical event or not, because there are countries who are telling people to leave Ukraine and join their country. So I think it's still very, very uncertain. Still, gas is not a positional short right now.
So, you know, for the Indian markets as well, when you look at the gas prices from 700 plus kind of levels to sub 500 is how we are trading right now. Do you see the same range holding for this quarter too?
I think the range would be on the downside. I don't expect it to go below 440, 450. And on the upside, I don't see it going above, 600 kind of level. So 450 to 600 should be the range for the winter season.
And how are you looking at the crude oil prices for this quarter now? Because yes, the winter season demand, as you said, there are various uncertainties still out in the market. The war is still on, the recession fears, the China zero COVID policy, expectation also that China could be coming out with more accommodative policies, stimulus measures too perhaps. How are you taking all of that into consideration and putting out a range?
For oil, I see a strong floor at $80 for Brent. And for WTI, I see a strong floor at somewhere at 78. I don't see it going below that because OPEC Plus is going to cut the production from next month. And the production cut is estimated to be as 2 million barrels per day. So right now, oil prices are not able to move up because of the weakness of demand from Europe or UK and the developed part of the world, and the expectation of slowdown in China. These are the factors which is not supporting oil prices to go up right now, and always the stronger dollar. But going forward, I'm not expecting oil to go below certain levels, like I mentioned, $80 for the Brent seems to be the floor, and there is a possibility during the winter season oil conservatively may test $100 for the Brent. So I'm not expecting any big spike in oil prices, but it can definitely test somewhere at $98 to $100 for the Brent. So not very bearish on oil.
All right, Kunal, as well as Manisha, thanks very much for joining in and giving us that perspective on the entire commodity space. For the markets holding up well, in fact, the 50-day moving average stands at around 17,491, and we've just about inched higher above that. With that, it's a wrap on Halftime Report. Business Lunch up next.